If I had to start protecting and building wealth today from scratch, knowing what I know about the global money order getting tugged, stretched, and quietly rewritten in plain sight, I would do almost everything differently. Because this is not just about picking a stock, it's not about chasing a hot chart. It's not even really about whether the next move is up or down next week. It's about understanding that the rules around money, debt, trade, banking, and trust are shifting at the same time. And when that happens, the winners usually aren't the loudest people in the room. They're the people who spot the rule change early, get positioned, and stop playing yesterday's game. Today is Wednesday, April 15th, New York time, so tell me in the comments what day and date you're watching from. And real quick, if you value this kind of content, subscribe and comment John A.G. Best so I know you want me to keep making it. Now, when people hear phrases like monetary reset, global realignment, or financial restructuring, they think it sounds dramatic. A little too dramatic. But then you look around, you've got US debt sitting just under 40 trillion. You've got inflation heating back up after people thought it was calming down. You've got gold ripping to fresh highs this year. You've got reserve managers around the world holding a smaller share of dollars than they used to. And you've got policymakers openly talking about rebalancing trade, refocusing the big post-war institutions, modernizing bank rules, and building new rails for digital dollars. That is not normal background noise. That is the sound of a system being adjusted while the public is still arguing about headlines. And I want to be very clear here. I'm not saying tomorrow morning you wake up and the dollar disappears. I'm not saying men in suits meet in a dark room and flip a secret switch. What I am saying is much more practical than that. When governments carry huge debt loads for long enough, when trade relationships get politicized, when central banks diversify, when commodity flows matter more again, and when digital payment systems get folded into the official conversation, money itself starts behaving differently. And if money behaves differently, your portfolio has to behave differently too. So let's talk about what this actually is. Because the phrase people keep throwing around points back to the old post-war settlement, the one built in the mountains of New Hampshire when the world wanted order after chaos. Back then, the dollar sat at the center, gold stood behind the promise, and a whole international framework grew up around stability, reconstruction, and trust. That structure gave the United States enormous influence. It helped make American finance the central station of global capital, but that version of the system did not last forever. By the time the late 1960s rolled around, pressure had built, deficits had piled up, and foreign-held dollars had grown beyond what the gold backing could comfortably support. Then came the break in the early 1970s, when convertibility ended and the old anchor was gone. After that, the system did not vanish, it mutated. Instead of discipline coming from a hard link, discipline became political, institutional, and, let's be honest, often optional. That changed everything, because once money is mostly managed through policy, confidence, and credit, the temptation is always the same. Borrow more, delay the pain, stretch the promise. Hope growth outruns the strain. Sometimes that works for a while. Sometimes it works for longer than people think. But eventually the bill shows up in some form, and it usually doesn't show up politely. It can arrive through stickier inflation. It can arrive through weaker purchasing power. It can arrive through asset inflation, where things you need get pricier while the things you already own look richer on paper. And that's where a lot of regular people get trapped, because they think they're being cautious when they're actually standing still on a moving floor. Now, based on recently published numbers, consumer prices in March moved higher again year over year, with energy doing a lot of the damage. That matters because once energy starts leaning on the whole system, the conversation changes fast. Suddenly people aren't just debating policy. They're feeling it at the pump, in shipping costs, in groceries, in airline tickets, in all the little leaks that quietly drain a household. At the same time, the debt load keeps towering over everything. And I know people get numb when they hear giant government numbers. It all starts sounding like monopoly money after a while. But debt matters because it narrows the menu. A heavily indebted system doesn't get to choose from every elegant solution. It usually chooses from the least painful, ugly solutions. That can mean a lower real burden through inflation. That can mean growth-first politics. That can mean pressure for easier financial conditions. That can mean more tolerance for a dollar that isn't as mighty as people were told it had to be. And here's where this gets interesting. The officials are not exactly whispering anymore. Over the last year, Treasury messaging has leaned hard into restoring balance in the international system, pushing institutions back toward core economic and financial stability missions, and reworking trade relationships that Washington says have hollowed out domestic production. That is not some random internet thread. That is establishment language. And once you hear it for what it is, you realize the conversation is bigger than whether one index is overbought on a Tuesday. It's about the architecture, Move one is trade. You don't have to agree with every tariff or every negotiating tactic to understand the direction of travel. The stated goal is pretty simple: less dependence, more domestic leverage, more favorable terms, and a stronger production base at home. Now, from recent official trade updates, the administration is already pointing to a narrower goods deficit versus the prior period and calling that evidence the strategy is biting. Maybe it works cleanly, maybe it doesn't. Maybe some of it is optics. Fair enough. But either way, the pressure is real. Companies are already being forced to think harder about where things are made, where inputs come from, and what happens if cross-border commerce becomes less frictionless. That alone is a huge shift. Move two is finance, not in the cartoon villain sense, in the more boring, more important sense. Bank capital rules are being revisited. Regulators are talking about streamlining and modernization. Smaller institutions are being talked about differently, and the message underneath all of that is pretty straightforward. There is a growing appetite to make the system more flexible, more adaptive, and depending on your point of view, more permissive. That can support lending. It can also support risk. Usually it supports both. And this is where I want to insert one skeptical point, because I don't want to oversell a neat story. Looser or modernized financial rules do not automatically produce a golden age. Sometimes they produce more credit, sometimes they produce more fragility wearing a nice suit. So don't hear this and think every policy adjustment is bullish just because it sounds growth-friendly. It isn't that simple. Move 3 is the money plumbing itself. Digital dollars, stablecoins, tokenized assets, faster payment rails, new settlement structures. These are no longer fringe words floating around crypto conferences. They are entering mainstream regulatory language. Recent U.S. policy steps have pushed toward a federal framework for payment stablecoins, while Fed officials have openly said these tools could end up helping trade finance, remittances, and treasury operations, even though today they're still used mostly around crypto activity. That matters, because once the state starts building rules around a tool, that tool is no longer outside the building. It's being invited inside, searched at the door, handed a badge, and told where it can sit. That's a different world from the rebel narrative people got sold a few years ago. And meanwhile, while all this is happening, the old signals are flashing. Gold has been hitting fresh highs again this year. Central banks have been accumulating gold at an unusually strong pace in recent years. And the dollar, while still dominant, makes up a smaller share of reserves than it used to. Let me say that differently. The dollar is still the big dog. But the rest of the world has not been standing still with an open mouth waiting for scraps. Reserve managers diversify. Trade blocs experiment. Commodity producers think strategically. Countries that don't want all their options routed through Washington build alternatives where they can. That does not mean the dollar is finished. It means the monopoly feeling is softer than it was. And that distinction matters, because one of the biggest mistakes regular investors make is thinking in absolutes. Either the dollar rules forever, or it collapses next month. Either America wins everything, or America is done. Both of those are lazy. Reality is usually much messier and much more investable than that. The United States can remain hugely important and still go through a period where the value of money feels less stable, imported things cost more, hard assets matter more, and domestic production becomes a bigger political obsession. Those things can all be true at once. And one more thing people miss. This is not only a U.S. story. Commodity exporters, select foreign markets, and multinational businesses can all benefit from a world that is less cleanly centered on one reserve system. So don't bet against America, but don't confuse that with betting only on America either. Some of the best positioning in a monetary transition comes from owning quality businesses with real assets, real cash flow, and exposure to more than one economic engine. That nuance matters more now than most people realize. So what do you do with that? First, you stop worshiping cash. I'm not saying keep zero cash. I'm not saying ignore bills, emergencies, or the fact that life happens on inconvenient days. What I am saying is that living heavily in cash for safety can become a slow bleed when inflation runs above what your cash is earning and the unit itself is under structural pressure. That is not safety. That is quiet erosion dressed up as prudence. Second, you actually learn what you own, not what the label says, what you own. Because a company can trade in New York and still earn a big chunk of its money abroad. A so-called domestic holding can carry international exposure through revenue, inputs, pricing power, or supply chains. So don't be simplistic. A ticker is not a geography lesson. Third, you think in layers. You want productive assets, you want some inflation sensitivity, you may want some hard asset exposure, you may want businesses with pricing power, you may want real assets that can pass through higher nominal costs. And yes, depending on your risk tolerance, you may want some exposure to the digital side of the future payment system too. But carefully, because a lot of garbage hides inside exciting narratives. Fourth, don't wait for the perfect trumpet sound. This is where people get themselves in trouble. They want one giant signal, one obvious announcement, one dramatic headline that says, "Congratulations, now is the exact correct day to reposition your life savings." That is not how regime shifts usually feel when you're living through them. They feel partial, confusing, contradictory. One week the dollar is firm, the next week gold is flying. One month inflation cools, the next month energy kicks it in the teeth again. One official says stability, another says restructuring. That is the game. So don't build your whole future around catching the exact minute the story becomes obvious to everyone else. By then, the easy part is usually gone. Now, if you're successful, share your success story in the comments so others can stay motivated. And let me challenge one more idea before we go further. A lot of people hear reset and immediately jump to, therefore, gold standard. Maybe, but maybe not. History rhymes. It doesn't photocopy. A system can become more commodity aware, more strategic, more fragmented, and more politically managed without snapping back to some perfect old framework from a different century. So I would be careful with anyone who tells you the ending is already written. What I'm more interested in is behavior. Who is buying what? Who is changing rules? Who is talking differently? Who is preparing for a world where trust is still central, but trust alone doesn't feel like enough? That's a very different question, and on that front, the evidence is everywhere. Treasury is talking balance. Trade officials are talking leverage and production. Bank regulators are rewriting pieces of the rule book. Energy data show the United States is still a production giant. Inflation data remind you how fast comfort can evaporate. And market action keeps whispering that people still want something hard, something scarce, something outside the promise of a politician. That's not paranoia. That's pattern recognition. So my framework is pretty simple. Own things that can adapt better than your cash can. Favor resilience over hype. Understand why you own each position. Don't overload on any one story, including this one. And keep enough humility to admit that policymakers can aim for an orderly transition and still end up with a messier outcome than they planned. Because that's the other thing here. There are really two broad paths. One is a managed squeeze where the system bends. The dollar loses some shine. Domestic priorities get more aggressive, and asset owners who stay thoughtful do reasonably well. The other is a sloppier version, where inflation bites harder, markets get more chaotic, policy credibility takes hits, and people discover too late that cash was not the safe house they thought it was. My guess? Reality lands somewhere in the muddy middle. Not clean, not apocalyptic. Messy, political, volatile, but manageable for people who are paying attention. That's why this matters. Not because panic is useful, not because fear makes money, but because understanding the direction of the tide can keep you from anchoring your boat in the wrong place. So tell me this in the comments. Do you think we get a slow motion reset, or do you think something breaks first? And second, when the rules of money start moving, would you rather own promises or scarce assets? Either way, don't freeze. The people who usually lose in transitions are not always the reckless ones. A lot of the time, they're the people who keep waiting for the old map to start working again. It won't, not exactly. And that's the whole point. This video is for education, for thinking, and for helping you ask better questions about your money. It's not personal financial advice, and before you move a single dollar, make sure the plan fits your life, your risk, and your responsibilities.